Well, that's a big question, of course. The inflation's here. So I'll say 2 years from 2020 to, and over the course of 2021, there was a big debate in economics and among analysts about inflation versus maybe disinflation. Still have inflation, but at a lower rate. And that debate kind of went on through all of most of 2021, but that's over. Inflation's here. There's no more debate about it. The new debate is, will it persist? Will it get worse, which it might, or will it be subdued in some way? Now, I have actually been in the camp. Again, you can see the inflation coming. It's here. It's going to persist for a while. That's the big question. Will it kind of tail off quickly over the next few months, or will it kind of be the dominant theme for 2022? I definitely lean to the latter. However, going out, maybe 9 months to a year, I see that curve bending and getting into a more disinflationary mode. Not for good reasons. Has very what does have to do with the Fed, in the sense that they've painted themselves into a corner. There's no way to escape the room. They can subdue the inflation, but at the cost of a very severe recession, not a mild recession, a very severe recession. So the question is, to me, the biggest question in economics is, will the Fed go down that path, do what they have to do the only thing they can do to subdue inflation at the cost of a very severe recession and something like a stock market crash? Or will they see that coming? They'll be the last to know. We'll all see it before they do, but they'll be the last to know. It's because they rely on flood models, and they're kind of in their own economic forecasting bubble, and they have very defective ways of thinking about the economy, and they're very much a creature of inertia. There are a whole lot of reasons why the Fed is not nimble. It's kind of quite the opposite. But they'll see it eventually, probably when it's too late. And will they balk at that point and stop rate hikes and maybe even reduce rates? That could save us from the recession, but that will just amplify the inflation. So rather than say which one's going to happen, I prefer to lay out those two paths and then just watch it very carefully. But more to the point, we've seen this movie before. This is a replay, and I think it's on, like you hit the remote control for double or triple speed. It's going to happen faster, but this is a replay of everything that happened from 2013 to 2019 and into 2020, which was, I'll just go through it quickly. So 2013, May, Bernanke says we're going to taper asset purchases. That's money printing, quantitative easing, whatever you want to call it. The market, tanks, bonds go down. Everyone's like, oh, it's over. And then Bernanke balked. But finally, in November 2013, they said, okay, the taper begins. They were still printing money, but at a slower rate, and that matters. That went on until late 2014. The taper was over. They stopped buying new assets. They said, okay, here come the interest rate hikes. Except they didn't come for another year. It wasn't until December 2015 that then Janet Yellen finally raised rates. And then another year for the second rate increase. So it was December 2016. So it was really, really slow. Took 2.5 years, but they got to 2 rate hikes. But then here comes Jay Powell. And then like clockwork, boom, 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 25 basis point hikes every meeting. And all the Fed was trying to do was to get back to normal. They were trying to get interest rates to maybe 2.25, 2.5, get the balance sheet down to, something like 2.5 trillion. They never specified it, but that would have been a reasonable level. So, okay, now interest rates are kind of normal, 2.5, balance sheet's down around 2.5 trillion. We're back to normal. We finally got through the global financial crisis of 2008. We undid all that stuff. Well, what happened? From October 1st, 2018 to December 24th, 2018, the stock market dropped 20%. That was the December 24th, 2018, we call it the Christmas Eve massacre. Stock market went down 3% in one day. But the Fed was tightening into the weakness, as they always do. And the last interest rate hike, it was December 16th or 17th, within a day or two, but mid-December 2018, they were still hiking and raising rates. And that was the last straw. And then the market just tanked. And then finally, Jay Powell got the message. First week of January 2019, he says, okay, that's it. We're going to be patient. Use the word patient. It's one of these code words. You have to get the code book out and see what it means. But patient means we won't raise rates again without giving you advance warning so you can get out of your carry trades or whatever. And then he went further, said, looks like we got to cut rates. And they did. And then by early 2020, here comes the pandemic. And then they took rates all the way back to zero, and then they started QE, I don't know, 6, 7, call it what you want. They took the balance sheet to $7.5 trillion after getting it down to $3.5 trillion. So look at that whole sequence from 2013 to early 2020, including the pandemic. What happened? They tapered the asset purchases, they raised rates, they sank the stock market. Then they said, okay, no more rate hikes. Then they cut rates, and then they started QE. And by April 2020, where were we? Zero rates, back down to zero, and the balance sheet was $7.5 trillion after getting down to about $3.5 trillion. So that was a big a circle. They ended up back where they started from. But the point being, they failed to normalize. They failed to get rates where they wanted. They failed to get the balance sheet where they wanted. They did sink the stock market. Okay, now 2 years forward, here we are again. What are we doing? They just raised rates at the March meeting. They're going to raise them again in May, and that's the easiest forecast I've ever made. 50 basis points, May 4th. Boom. You can count on it. And they're going to announce. By the way, I don't have a crystal ball. The Fed told us this. I mean, that's the thing about the Fed. They may be wrong, but they're transparently wrong. So they tell you what mistakes they're going to make in advance. So that's the Fed forecasting is actually fairly straightforward because you just have to believe them. So they're going to raise rates again in May, probably 50 basis points. They're going to announce a reduction in the balance sheet. Whether they actually start it in May, they probably will. $100 billion a month reduction in asset purchases. So that's QT, quantitative tightening. In other words, they're running the same playbook they tried to run, or they started to run in 2013, 2014. But here's my question. They failed the last time. Why do they think they're going to be any more successful this time? Why do they think they can get out of this? And the answer is, the answer is they cannot without a recession. Now, and this is what Larry Summers has been saying. I think he's right. And everyone's jumping on board, Alan Blinder and all these other big brains from Princeton. But the point being, they can normalize rates in the balance sheet, and they can stop inflation, but not without causing recession and not without causing a stock market crash. So the big question for the next year is, will the Fed do that? And they may. Paul Volcker did it. Or will they balk again, at which point you might rescue the market, but the inflation is just going to go wild. That's the debate. But the thing is about framing it that way. You've got two paths, and we'll get signals along the way. We won't be the last to know. The Fed will, but we won't. You'll be able to see this coming.